Hello, and welcome to another stock analysis on Stock Market Palantir. Don't forget to subscribe and drop your comments. Now, let's go hear our analysts.
Welcome to the Stock Market Palantir. Today, we are going to talk about GOOG. And well, when we look at Alphabet Inc. right now, here in late 2025, we are immediately confronted with a pretty critical structural crossroads. The stock has been, incredibly volatile.
To say the least.
Yeah, exactly. And it's driven primarily by what everyone is calling the Atlas shock. That's OpenAI's browser launch back in October. And that event wasn't just a new product. It really signaled a fundamental shift toward agent-based search. And the market, well, it reacted violently. We saw an immediate impact. The stock tumbled nearly 5% intraday, wiping out something like $100 to $150 billion in market value. It fell from around 252 to 246. Now, since then, the company has stabilized a bit. It's trading around 318 to 320 in early December, mostly following their aggressive product counteroffensive. But the anxiety is still there. Implied volatility sits near 31%, and the options market is still pricing in a really significant expected weekly move of over 3%. So the central question we have to face is this. Is Alphabet's current valuation, which looks significantly cheap compared to its peers, a genuine deep value opportunity, or is it a value trap that's accurately reflecting this threat of structural search erosion? I maintain it's the former. I think the financial infrastructure and its overwhelming data advantage reveal a deeply undervalued opportunity that the market is just completely mispricing.
I see why you emphasize the cash flow, I do, and that recent recovery. But I come at it from a completely different perspective when it comes to risk. I believe Alphabet is dangerously positioned as a classic value trap. I don't think the market is mispricing risk. I think it is rationally pricing in a potential decline. That apparent valuation discount you mentioned, it's not a bargain, it's the appropriate assessment of an existential threat to their core revenue engine. I mean, when you look at platforms that miss major technological shifts, this feels a lot like a potential Kodak moment for the digital age.
A Kodak moment is a strong claim.
Well, we have to analyze the math of the search erosion. Search revenue is just so massive that the immense growth we see in segments like Google Cloud Platform, even with 35% growth in Q3, it simply cannot compensate for decay at the core. We've seen analyses suggesting that a mere 3% drop in search operating profit would require cloud profit to effectively double just to neutralize the overall impact. That shows you the vulnerability of the entire ecosystem. And the threat is structural. OpenAI's Atlas has what they call agent mode. This is not just a search box. It automates high-intent tasks like, booking an entire trip or executing a complex shopping list, and it bypasses that crucial search, click, link, ad funnel entirely. This targets the most profitable commercial queries, and that's what justifies the current discount.
Okay, that's a compelling framing of the technological threat. And I agree that the narrative is potent. However, the financial reality, I think, remains the anchor for the stock, and it proves the discount is substantial. The core of this deep value thesis is that undeniable valuation disconnect. Alphabet trades at roughly 27.1 times forward PE. That is a substantial 27% discount compared to the average of the Magnificent Seven peers, which sit near 37 times. That kind of margin of safety just does not exist for the rest of that peer group, and it implies that the market has already factored in much of the erosion you're predicting.
But has it factored in enough?
Well, look, we also cannot overlook the unassailable Fortress balance sheet. They have over $76 billion in net cash, and their debt-to-equity ratio is 0.11? It's essentially negligible. This is financial firepower that very few companies on Earth can match. Furthermore, management is aggressively signaling confidence through this pivot towards shareholder returns. They initiated a new 20-cent per quarter dividend and are conducting really aggressive share buybacks. These moves are crucial because they set a fundamental, demonstrable floor for the stock price. It's asserting financial maturity and confidence right when the market is panicking.
I'm sorry, but I just don't buy that the discount equates to immediate safety. You correctly cite the strong Q3 earnings, surpassed $100 billion in revenue, cloud growing robustly. But those impressive figures are backward-looking. The market isn't making an emotional error here by overcorrecting. It is rationally forward discounting this anticipated structural erosion. If institutional investors perceive management as sluggish and, we hear comments all the time characterizing leadership as a peacetime CEO, ill-equipped for this AI platform war, then the discount isn't a margin of safety. It's what I'd call a necessary bureaucratic discount.
A bureaucratic discount?
Yes. It reflects the risk that a massive matrix organization like Alphabet will just be too slow and too reactive to combat a utility leap like Atlas Agent Mode. The consensus on Wall Street is becoming skeptical about the long-term viability of maintaining those historical earnings estimates if high-margin search traffic truly begins to migrate. A 27 times PE might look cheap today, sure, but if earnings per share drops 15% next year, that suddenly becomes a 32 times forward PE, which is far less appealing. The valuation is cheap because the risk of erosion is high, not in spite of it.
I acknowledge the internal drag that organizational size can create, but the evidence of their counteroffensive suggests the market is still overcorrecting. The sheer scale and, frankly, the continued health of the Q3 earnings validate the integrity of the core business, even under this external pressure. The discount itself proves that the market is already priced in substantial risk, arguably more risk than is justified by current performance. And let's pivot to the technological moat, because this is where the deep value thesis is fundamentally protected. You speak of agent mode as a utility leap, but Alphabet has inherent structural advantages that ensure stickiness. I mean, while consumers might try new things, Chrome isn't going anywhere. It takes a monumental, sustained force to break a decade of ingrained consumer muscle memory. More critically, we have to discuss infrastructure superiority.
Google's vertical integration with their proprietary tensor processing units, or TPUs, that provides a distinct and massive cost and performance advantage over competitors.
Right, the hardware.
The hardware. Most competitors, including OpenAI's partners, are forced to pay the highly expensive NVIDIA tax. They're relying on external, costly, and heavily constrained commodity GPUs. Google, by contrast, designs its own specialized silicon. This is the long-term protector of margins. It gives them cheaper and faster training and inference for their large models. The stabilizing effect we saw in November was directly tied to product wins, like the new Nano Banana Pro initiative and the seamless integration of their flagship Gemini 3.0 models directly into search, demonstrating they can rapidly innovate and defend their core turf using their superior chips.
Okay, but that argument about TPUs providing a margin advantage is compelling, but it only holds weight if the top-line revenue is secure. If Atlas succeeds in automating away those crucial high-intent commercial queries, the advantage of cheaper chips just means less overall profit. You're defending the margin structure when it's the revenue base that's under threat. The technological threat is not inertia. It is, in fact, a utility leap, and that breaks muscle memory very quickly. The Atlas shock wasn't just a browser, it's a freemium Trojan horse. It offers a leap in utility with full agent mode features that fundamentally rewrites the user journey. Look back at history. When Chrome displaced Internet Explorer, it wasn't a slow crawl, it accelerated because the utility and the speed were just dramatically superior. Users will always follow the superior utility, regardless of brand loyalty or infrastructure cost.
The key vulnerability is that agent mode directly attacks the middle layer of the monetization funnel.
I acknowledge the historical parallel. I do. But I believe the current institutional positioning suggests a much more complex picture than just mass flight, based on utility fear. We really need to look closely at the institutional data, which, I'll admit, offers contradictory signals. You correctly point out the caution reflected in dark pools, with these persistently high off-exchange short volume ratios, sometimes exceeding 50%. For those unfamiliar, this means major institutions are conducting a significant amount of their trading off the lit exchanges, often hedging or exiting large positions defensively, without signaling their moves to the broader market. This high volume certainly indicates aggressive institutional hedging.
Exactly.
And this is part of that great rotation. It's a messy process, where growth-focused funds, like Capital International investors, are indeed decreasing positions by close to 7%. This turnover creates volatility.
Right. And the fact that this high short volume is happening in dark pools suggests smart money is positioning defensively. They are trying to liquidate or hedge massive blocks of shares because they believe the structural decline is coming. This isn't just retail fear. These are sophisticated players who are anticipating further erosion based on the agent mode threat. And that's leading to a choppy and downward-biased ownership transition. They're waiting for quantifiable erosion before they cover those short hedges.
But see, that interpretation focuses only on the selling, and it's missing the massive accumulation that is simultaneously occurring. I'd offer a necessary contrarian interpretation based on the options market. While the dark pool data indicates aggressive hedging and, churning ownership, the put-call ratio stands bullishly at 0.74. A ratio significantly below 1.0 indicates a clear bias toward call options, suggesting traders are aggressively buying the dip via calls, betting heavily on a rebound in the near term. Furthermore, look at who is accumulating. JP Morgan Chase, for example, increased its position by a staggering 36.64% in the most recent filing. That is a massive vote of confidence from a major value desk. It signals they view this volatility as an accumulation zone, not an exit. So while growth funds may be rotating out, traditional value investors see the discounted price relative to the fortress balance sheet as an irresistible entry point. The volatility is a churn of ownership, yes, but it's a churn into strong hands.
That is a strong counterpoint regarding the accumulation from value funds. It speaks directly to the financial strength you noted. However, let's pivot back to structural risk and governance, because I think this puts a permanent ceiling on that valuation, even for value investors. You mentioned the strategic corporate actions, the 2022 20-for-1 split, fine, useful for retail accessibility. And the recent DOJ ruling against forcing the sale of Chrome. Yes, that did remove the worst-case regulatory breakup scenario. That was good news. But it also ironically validated the gravity of the competitive threat that the market is now so focused on. But we need to acknowledge the other, more controversial structural action, the 2014 2-for-1 structural split, which created the GOOG Class C non-voting shares. This was solely designed to solidify the founders' control. Despite the DOJ relief, the existence of the regulatory overhang, the constant threat of antitrust scrutiny, coupled with that tight internal control structure, creates a permanent valuation ceiling. It keeps that bureaucracy discount permanently in place because investors fear regulatory action and, crucially, they fear that the tightly controlled management team will be slow to respond to the Atlas threat. Structural governance issues ensure this stock cannot achieve a premium multiple regardless of its cash flow.
Well, while the founders' control structure is a legitimate point for governance discussions, I think their strategic moves have consistently been aimed at maximizing long-term stability and shareholder access, especially with that 2022 split. The stock has been adjusted multiple times, demonstrating a focus on liquidity and accessibility, which is really the opposite of the signs of distress you see with a true value trap. Furthermore, the relief from the DOJ's worst-case breakup scenario provides significant long-term structural certainty. Management is now free to fully focus their massive resources on fighting the competition, Atlas, rather than the regulators. That is a substantial long-term benefit that the current discount is not properly reflecting.
Ultimately, I fully acknowledge Alphabet's financial superiority. The deep cash reserves, the staggering cash flow it generates today, it's all there. However, I believe the market is correctly pricing in a rational, justifiable fear of platform obsolescence driven by the utility leap of Atlas agent mode. The tension between the bullish narrative of financial certainty and the bearish reality of technological erosion means volatility will remain elevated and price discovery difficult until we see clear, quantifiable evidence of Atlas's long-term impact on search market share. Until that visibility arrives, this stock remains a trap for long-term capital seeking minimal risk.
And I'll reiterate my position. The company is fighting back with superior infrastructure, specifically that low-cost advantage from the TPUs and a deep cash reserve that rivals sovereign nations. The recent price action is a violent, short-term response to a genuine paradigm shift, no doubt. But the underlying fundamentals, the superior valuation metrics compared to its peers, the massive cash pile, and the new aggressive capital return policy all confirm this is a fundamentally sound company transitioning from a pure growth monster into a quality value holding. The market, in time, will be forced to price in the fortress balance sheet over the short-term fear narrative.
So we're left to weigh that profound tension between financial certainty and technological erosion. knowing that the winner will likely dictate the next decade of market leadership.
That profound tension is clear. On one hand, we have undeniable financial stability, evidenced by a valuation nearly 30% cheaper than its peers and over $76 billion in net cash. And that stands starkly against the immediate technological threat posed by Atlas Agent Mode, which attacks the core revenue stream. The situation is further complicated by the contradictory signals from institutional money. You have high dark pool short volume suggesting hedging versus the high call option buying and accumulation from major value investors. Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.